Good morning, everybody. My name is Barrett Ayers, and I'm the president of Adhesion Wealth, and very appreciative that you joined us this morning. I want to thank you for attending. So we're going to keep this relatively brief, but I'm really excited to be hosting this meeting. We're going to be talking real quickly and doing a quick recap of the FOMC meeting that concluded yesterday. And to help kind of spur this conversation along, I'm excited to be joined by Kevin Flanagan. He's the head of fixed income strategy at WisdomTree. And good morning, Kevin, and thank you very much for joining us today.
Good morning. Glad to be here. Sorry, I'm a little less formal. I have trying to put my green on for St. Patrick's Day.
I forgot. I'm wearing all blue. So, well, we're glad you joined us. And so let's just jump right into this. The market just opened, and I know folks are eager to kind of interpret what happened yesterday. And so, so Kevin, there was a lot of talk, obviously, leading up to the meeting that it's going to be one of the most important FOMC meetings in recent memory, as I think it sets the stage for the Fed's inflation outlook and the controls they have for at least, I don't know, maybe a year to come. As I think about how we, can now conclude that inflation is not transitory, as I think we were all talking about last year, the Fed took some pretty meaningful actions yesterday, and I think shared some impactful insights into their stance on the balance sheet and ongoing monetary policy. Can you just give a quick recap of, from your perspective, what happened yesterday?
Yeah, it was probably one of the most well-telegraphed Fed outcomes that I've seen in my career. And it all goes back to a couple of weeks ago when Chairman Powell was speaking before Congress, doing what we used to call the Humphrey Hawkins testimony. He knew all eyes and ears were on him, right? I mean, at that point, everyone was wondering, is it going to be 25? Is it going to be 50? And when he used the terms, I'm going to recommend or I'm inclined to go 25, he pretty much tipped his hand completely. So from that vantage point, I don't think what the Fed did yesterday was any surprise. And, the markets had been pricing in essentially a rate hike for the remaining meetings. There's 6 meetings left for this calendar year, 2022. Now, when I say the market has been pricing in, talking more about Fed funds futures, Treasury yields have been pricing in rate hikes, but they're not priced for a 2% Fed funds target. So if the Fed follows through on their dot plot, which is essentially their own internal forecast for Fed funds, that's where we will be. If they just do a quarter point for the rest of this year, for the next 6 meetings, Fed funds will be in a range of 1.75 to 2%. And don't forget their balance sheet. So they're going to be quite busy, and that may begin to see some runoff in May.
Yeah, so you speak about the balance sheet. So how aggressively do you think they're going to start unwinding that balance sheet?
Well, I think during the press conference, Powell intimated they would use similar, I think, kind of measures as they did after the financial crisis when they were paring down their balance sheet then. I just think it could happen quicker. So the amounts may be somewhat similar in the drawdown, but I think the pace of it could be quicker this time around. And what's really important about that is that creates an avenue here where all Treasury yields essentially could be under upward pressure. So it's not just Fed funds, right? It's something tied to Fed funds. If you're talking about your balance sheet, that takes it all the way out to 30-year Treasuries, and even tips, even real yields could be impacted by this.
But do you see the yield curve currently reacting to the potential of unwinding long-term notes, or do you see, because right now it looks like the short end of the curve is flattening, but what does the long term look like?
Yeah, I mean, that's a great question. This is the narrowest the yield curve or flattest the yield curve has been to begin a tightening cycle going back to 1990. I think the Fed would prefer not to have the curve invert too soon. Right. And perhaps that's going to be the mechanism they use to try to prevent that, is drawing down or running off on their balance sheet. So it will be interesting to see. The one thing I think that's important to add for people on this call is that if the curve does go inverted, it's not, in our opinion, the same kind of indicator for recession as we've seen in the past, because the Fed just got finished buying $4.6 trillion in treasuries and mortgage-backed securities. So there's a difference. I hate to say it's different this time, but it really is. I mean, when the Fed's buying nearly $5 trillion, that's going to have an impact, I think, and artificially keep longer-term rates down.
Yeah, so it's interesting. You bring up kind of the historical context going back to, I think, 1980, perhaps even to the 70s. And so I've heard some people yesterday, in fact, make some historical comparisons. I've heard the comments likening the series of rate hikes to kind of a Volcker style, really aggressive attack on inflation, which I'm not sure ended all that well, to maybe more of a Greenspan like soft landing. Where do you think on the spectrum we stand with the planned rate hikes in the perspective of the Fed?
I think you have to look at what's our starting point. What the Fed is doing right now is just beginning to remove emergency measures from the COVID lockdown from exactly 2 years ago, March of 2020. So they're starting at zero. And I think that's important. It's not like they're starting raising rates at 3%. They're starting at zero. They have a lot of catching up to do. And back to the balance sheet's $9 trillion. There is a ton of liquidity in the system. The Fed just finished last week adding to their balance sheet. So essentially, they're just beginning the process of removing these emergency measures. To get to restrictive territory, we got a long way to go. Just go back to what I said a minute ago. If they were to do 25 basis point rate hikes for the rest of this year, that only brings the top end of the funds rate to 2%. And I think a lot of people lose sight of that.
Yeah, it certainly was absent from most of the comments I heard yesterday, hearing about Volcker, who, thinking about mortgage rates back in the, was it the 70s? We didn't start from a very low point when he got very aggressive, right? We are starting from effectively zero. So there's a ton of runway there, right?
Yeah, I remember the first house I bought. I think my mortgage rate, I'm going to date myself, was like 9% or something. And rates came down, and I rushed to refinance to get like 7% on my mortgage. I
Right.
think for a lot of people, maybe on this call, if you're not as old as I am, so they're thinking 7% mortgage. That's just crazy.
Right, right. So the environment is entirely different, but there's a lot still to unpack here. And so, when you start thinking about, the balance of 2022, I guess, are you seeing the Fed play, defense here? Are they catching up, or is this more of like a just-in-time series of rate adjustments? How are they going to play their cards, do you think, going forward?
They are definitely playing defense. It's going to take a while before they get on the offensive side of this thing. So, I mean, could they do a 50 basis point rate hike in this cycle? Absolutely. And maybe that's how they try to get ahead of this. But back to the point before, if we have CPI, think about like it's almost just the math behind this. If you have CPI running close to 8%, even if you raise the funds rate to 2%, I mean, think about how far behind inflation you really are. And if you want to even use the argument that, okay, inflation will come down this year, do you really think it's going to come down to 2%? Or is it going to come down to more like 4%, which I think is a more reasonable scenario? So the Fed has a lot of catching up to do.
And I guess you can see that in the dot plot that came out yesterday, right? I mean, it looks like the outlook is going to be relatively modest, but they've got a long ways to go before they're catching up and playing offense. And I guess, the folks attending the session today are advisors. And so, I thought maybe it might make sense a little bit to help translate that to how an advisor might want to think about, repositioning a portfolio or taking calls from clients. And, as an advisor, I'm thinking, this is the one thing I know about this environment is it will continue to be volatile, especially as we go into, midterms and, oil prices and the Ukraine-Russian conflict and, COVID, which I assume is becoming less and less of a factor, except for the recovery. So if you're an advisor, how would you think about repositioning a portfolio for, say, the next 12 to, I don't know, going into next year, 18 months maybe?
I think you just made some great points. And the one that really struck me when you mentioned COVID, if you look at the Fed statement yesterday, there was no mention of COVID. So it's probably the first time in 2 years that they've not gone down that road. So what we've been talking about, geez, it's got to go back to at least last summer, if not a little bit earlier, when we were starting to see inflation begin to percolate. We were never quite in the transitory camp. We've been in a rising rate type of mode. We've been trying to prepare portfolios for rising rates. Now, I'm a bond guy, so on the stock side, I won't mention much, but we would tend to probably focused more on value on the stock side. But within fixed income, our process here has been shortening duration. I mean, the benchmark, right? Most people have a core portfolio holding for fixed income, and it's ag-like. The ag is nearly 7 years in duration. It's the widest duration that we've ever seen. As a matter of fact, the ag so far this year has produced its third worst performance ever. So what we're talking about here is complementing your ag-like performance, because obviously if you are looking at a core, that's more of a strategic holding. And what we want to do is layer in some rate protection on that front to help get us through the next couple of years of what we think is not just the Fed raising rates, but the Fed being the catalyst, where you could very well see, if you go back to 2018, you had the Treasury 2-year, 5-year, and 10-year yields all coalesce around 3%. So, I mean, we're at 215 on the 10-year now. That's still a long way to go. The 2-year yield is still under 2%. So we still have some wood to chop, and I think that rate hedging is a key part of your bond portfolio.
Gotcha. And so you talk about duration too, and you said the ag is at 7 right now. Is that right?
Yep.
That's amazing. So how do you position and how do you look at duration now? I mean, what should advisors be thinking about doing in the duration camp?
Well, is obviously you want to try to offset or complement that as best you can. One way of looking at this, because we don't think anywhere along the yield curve is going to be spared, that you're going to see rates rise pretty much throughout the yield curve and tips. So, we like to look at Treasury floating rate notes. It's a strategy that a lot of people are not as familiar with. When you hear floaters, you usually think about your usual corporate floaters. But that's the key, is that these are 100% Treasuries. So it's more of a natural play because they reset with the weekly 3-month T-bill auction. So as the Fed moves, or a little bit beforehand, these get adjusted higher, and it's only 1 week duration. And you don't have to worry about any kind of credit exposure that you could get in some of the other floaters that are out there, which tend to be, by the way, heavily concentrated in financials. And one thing we've seen so far this year, and say over the last 6 months, a lot of ultra short duration that's out there that does have credit is actually negative. And, before this, Barrett, we were talking in our Dean Witter Morgan Stanley days, the last thing you wanted was statement risk. And if you have a rate hedge play on, you don't want that to be negative. Excuse me.
Yep, that totally makes sense. And so I guess if I'm an advisor and I'm thinking about, what is in the future and what I should be looking at, help us think about some key indicators, right? And so I know that personally, there's a handful of things that I look at as a barometer of what's on the horizon. Are there things, and personally, looking at obviously what's going to happen with the Russian invasion, the stress caused on oil prices and futures and commodities, job growth, the overall labor market. You keep an eye on China, obviously. What are you looking at to start to be kind of a predictive, indicator of what the Fed may be thinking about?
Well, I think Powell provided us some guidance yesterday. He actually was saying we're taking this month by month. That may almost be a direct quote or darn close to it. So what that means is the Fed's going to be very data dependent. So they're going to be focusing on the numbers that come in. Jobs report first to mind. Second on the list, inflation, beyond the shadow of a doubt. What I thought was very telling from his comments and also in the statement itself was when they did mention Russia and Ukraine, there was really no mention about the economic ramifications or repercussions. It was more on the inflation side of things. So it would seem to me as that's where the Fed is headed here. So jobs report, wages, CPI, to name a few things to look at. And one other thing that I also like to mention, this is a little bit more in the weeds, but the funding markets. That was something that we saw occurring during the financial crisis, during the original COVID lockdown, to see if there's any stresses there. And so far, it seems as if we're dodging some bullets. There are a couple of hiccups that we've seen, but nothing major there. So I would say for the Fed, they're kind of on rate hike, balance sheet runoff, autopilot, and the only thing that would derail them would be a meltdown in one of those markets that I just referred to, or if you were to see some signs of some economic slowing. That's why I think at a minimum, instead of getting caught up with they're going to raise rates at every meeting, it's going to be 50 basis points. I think what's fair to say is they want to front load so that they raised yesterday, and more than likely they'll go in May, June, and July, and then we'll see where we are from there. That's the way that I would play this right now.
Got it. Got it. Steer, much like steering a boat, right? I think that was the concept that has been used in the past. So yesterday we talked about this before we started the call today. I think I heard the word flourish. I'm pretty sure in the minutes and the transcripts there's the use of the term flourish, and it was funny watching the market react yesterday to to the change in Fed funds, but then shortly afterwards, of course, the market corrected a little bit, and then shortly afterwards, when the notes came out, and the Q&A and all that came out, it seemed like the use of the word flourish was in there, which I thought was a very positive interpretation of perhaps what happened yesterday. And how a less than accommodative monetary policy environment could still create a flourishing environment. Do you look at it that way too, or are we? I guess to your point earlier, we're still playing defense a little bit. It's going to be a while before we're playing offense. But do you see?
Right. I think as long as Powell and company don't surprise the markets, that there's no reason to think A, where we're starting from, B, that these are emergency measures they're removing, that we need to get into stagflation. So I look at it, inflation without the stag. I think that's probably what we're focusing on, at least for the remainder of this year, maybe the next 12, 15 months, something along those lines. If the Fed starts moving at 50 basis point clips, not just one time. I think the market would give them a mulligan to do it one time. But I think if they were to begin to, say, show more than one increase of 50, I think that's when the markets would get more skittish.
Got it. That completely makes sense. Well, good. Well, Kevin, I wanted to keep you for 15 or 20 minutes, make sure that we got some important information out there for viewers and folks. And so I really appreciate you taking the time. We're going to go ahead and wrap it now. And like I said, Kevin, really appreciate your time and look forward to doing this again in the near future. So thanks, everyone.